Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, June 5th, 2020. What we're going to do is take a look at the stock market and then roll into bonds. I want to touch on Treasury bonds and junk bonds, some developments there. Worth noting, updates on gold and silver. That'll include all the risk-off assets, Treasury bonds, gold, silver, which right now we're in a risk-on environment, risk-on day right now, meaning they're buying, most of the buying is in stocks. Those are the risk-on assets, and the risk-off assets like treasuries and gold are getting sold off. So we'll do updates there, hit on the US dollar, euro. Time permitting, I'll roll into some of the commodities I've highlighted recently that are also moving along with the market. And then I was out today. I had to step out this morning and when I came back, just catch up on the charts. I had a price alert go off on a trade idea that looks pretty good. I'll share that one with you. All right, so today is really impossible to chalk up as anything but bullish. It's almost a 3% rally in SPY. We're still above this trend line here. This is the 60-minute, on the 60-minute chart, that trend line we've been tracking. We're above that, and that's certainly a level to watch. The other thing to mention, a couple other things on this daily chart, are a big old gap right here. I think it was last week or earlier this week, I covered the 11 sectors in the S&P 500, most of which were at trading either just below or at the top of or within some very significant gaps that occurred on the way down. But on SPY, this is the most significant. This really kicked off the party right here, and we're coming up on that. So that is, and it's not just a gap too. There's also some nice price resistance. So I have the line at about 322.72, so we'll round that off, call it about 323 or so. And we are, for the first time since the last bull market, and I hate to use these terms, I told you guys before, the old, the definition of a bull and bear market is a rise of 20% or more, or a drop of 20% or more. As I said, those definitions are antiquated in my opinion, especially in this day and age of massive central bank liquidity injections, and they created what I refer to as a supersized bull market. That was the term I used for the one off the 2009 lows, and longest and strongest, and therefore these big corrective waves, they were in some cases drops of right around 20% or a little over 20%, and but when you look at it this way, they just look like waves. And a lot of I will say a lot of the some of the long-term trend indicators that had flipped to bearish have flipped back to bullish. But we still have to see a close this month. We're going to wait and see how the monthly candles close. But right now, like I said, today, if we finish up like this, certainly bullish. Should take a pretty heck of a fade into the close today to reverse these gains. So let's just take it one day at a time, and just want to mention that's where we're coming up on resistance. And then again, where I was going with that is this is the first time we've reached overbought. And what you need to realize is, as I talk about this, in a bull market, it's common to get overbought and then stay overbought, have these persistent overbought readings. In a bear market, you become oversold and you tend to stay oversold for longer. Whereas in a bull market, oversold is usually a one and done. You can usually, when you cross that 70 level or 30 level, you can step in and buy, and it's usually a great time to buy. Even if it's just for a bounce, those are usually double-digit bounces. So something to note there that if this is, and we're still about 6% off the highs in the market. Remember, this is the stock market. The Dow, the S&P, even if you include small and mid caps, they are all off their highs. The only thing making a new high today, which is bullish in itself, is QQQ, but that's mostly a tech index, about 50% in tech. So I did want to point out the overbought conditions. Overbought is not a sell signal, but if this does prove to be a bear market rally, then this will most likely be a very fleeting reading, and it will be kind of like this in reverse. Last bull, great time to step in and buy. So we'll see. Time will tell, but I wanted to point that out. Okay, so in summary, strong advance today following this breakout right here. We had this multi-week consolidation. The initial move above there was not impulsive at all, but then we started moving higher, and we obviously last week or so has been pretty strong with today. So we have a big gap to watch coming up on gap and price resistance overbought for the first time in a while. And again, if this proves to be in hindsight, or down the road, I should say, a bear market rally, then usually in a bear market, almost always, you don't stay overbought for very long, and you don't get extremely overbought. In other words, you get a little bit above the 70 level, and then that's it. That's usually how it works. And again, in a bull market, you stay overbought for a while, and you want to buy those pullbacks to the 30 level on the RSI. Whereas in a bear market, the initial pullback, oversold at 30 level or below, you tend to stay there for a while. So if you stepped in and bought oversold, in a bear market, or you did the last time, then you went very, very far underwater. All right, so QQQ, that's SPY, and that's what to watch for there. QQQ is just above, it's breaking out above the previous high. Again, as long as that sticks, as long as we close there today, and then sticks, next week, and they build on it, great. But you're also at the first overbought reading in a while, and again, this is not a diversified index. This is 50% technology. This is an index, a NASDAQ 100, that doesn't have financials. There's technically it's like a fraction of 1% weighting. So effectively, you don't have any of the financials in there. So it's not as diversified. In other words, it's not representative of the U.S. economy. It's more representative. It's what's the tech sector. So I like to compare it to XLK because they almost look identical. So that is, but again, anytime something breaks out to new high, as long as it sticks, it's hard to argue that as anything but bullish. Because what happens, the reason a breakout to new high is bullish, is that everybody in the security at that point in time is profitable. So you don't have any remorseful longs that are, waiting to get out, waiting to sell on the first bounce. So that's bullish. Now, if it fails, and if it fails, we have to look at that. What will it look like? And one thing I'm watching, just like SPY, I showed you, we're watching these trend lines here, and these are the same ones on the 60-minute chart. So we're still above trend there. Need to take out those trend lines. And let's look at one more. IWM had a very impulsive gap and big move above that resistance level. So there is absolutely no way to spin this as bearish. The official trade, we have two stops. If you're only targeting T1 or T3, that stop was hit today, but the max stop is up here. Remember, IWM is still in a bear market. It's still very much off the highs. IWM, unlike the broad market, the small caps peaked back in 2018, and they're still 14% below that level. But when you see a big resistance level with a lot of reactions like this, that's that 145 level taken out, and taken out impulsively, again, there's no way to spin that as bullish. So would I add to this? No, absolutely not today. Only if it failed. If we reverse, something big happens next week, remember, just like SPY and QQQ, we have these nice cleanup trend lines. So as of now, like I said, you can't spin that as anything but bullish. And we actually had a trend line here. There's that low right there. Let me turn down the volume bars, get those out of the way, and you can see the bottom of this candle. We had this trend line here that was broken, back tested, and it's being back tested again. So can a case be made that this is a breakdown of backtest? Yeah, but you need to get a sell signal, a solid sell signal. You need to break this trend line or see something big happen next week that reverses this move, this breakout above 145. So until then, like I said, nothing but bullish. But do you want to chase it here? Overbought again, first time in a while, and last time we were overbought was right here. We had an overbought reading there. And that one was followed by a big drop, and you can go back for a while and see the other readings there. And again, this oversold reading was quite extended and more indicative of bear market action. So only time will tell, guys, if this is a bear market rally. I still highly suspect so. I know the Fed has come in, and a lot of this rally, I think a lot of this juice is people are realizing now the Fed probably overstimulated the market. But it's more about perception. It's everyone's perception. This is a big guessing game. Is the worst over? And I fundamentally no. I know today's numbers on unemployment came in much better than expected, much better than consensus. But everything that I've read and everything I know to be true says we're still coming off such low levels, and all these surveys point to we're not going to the job market will be it'll take a long time to recover to where it's at. So when you put it that way, and remember, jobs are everything. Consumer spending accounts for 2/3 of GDP, gross domestic product, which is really, think of it like the stock market's earnings, if you will, the economy, total output. It's for some simplistic view, of course. So to have the stock market, within 6% of where it was when it was firing on all cylinders, there is still that huge disconnect. I understand that things right now, with the economy coming back online, are better than some might have thought they would be at this point. But again, the disconnect between equity valuations and where the stock market is and what's actually going on in the economy, despite that, we have this blip upward in the employment situation, again, is scary. So my longer term outlook hasn't changed, is what I'm trying to say. I believe that this was most likely the start of a bear market. Do we come and take the new highs? I don't know. We're within 6%. But like I said, there's big resistance here, and nothing at all would surprise me. So we'll watch this trend line for a break next week, whether it comes to next month, and that would be your sell signal. You also have a big old gap right here now, the third gap. Remember on that 60-minute chart, we had these two recent gaps, 1, 2, 3, and now 4 actually. Quite unusual. Is that bullish price action? Yeah, gap, gap, gap. But again, I am skeptical for many reasons, including not limited to the technicals. But again, today's technicals are nothing but bullish. But if they're reversed, gap down next week would leave an island top, things like that, then that will change things. And here's that trend line. So I'm going to set an alert right now. I probably already have one, but I'll make sure. So those are what I'm watching for next week, and then let's cover, where the money is to be made on the, other things right now, like silver. Silver's already dropped about 6. Well, that's silver. I think silver futures was about 7 or 8. That's what I've been tracking and trading. It's about, well, from the highs there recently, better than an 8% drop. And the thing about it is, the dollar hasn't even broken down yet. So there's silver. We hit those first 2 targets. Posted this morning. I had to run out, but before I left, I got this chart out, and that opens a door to a move down to 17,258. So what's going on right now is this is, well, it was technically driven. Again, in my opinion, these things aren't random. That the news and the charts, this is all this stuff is so interconnected, fundamentals, technicals, that the rally in the stock market was a catalyst for this. I was suspecting that we would have a breakout in the dollar, which would be the catalyst for this drop, but it wasn't that so far. And if we get that, again, my point is we're seeing the stock market rallying. So what you're seeing is risk-off assets like gold and silver are dropping. But again, it was also priced into the charts. And so if we get the breakout in the dollar, that would be that much more a tailwind for a short trade on silver and gold. So right now it is a breakdown. I still expect at least a move down to this target here, but I'm very curious to see how the stock market closes today. If they fade any or a good part of the gains into the close today, and of course it's Friday, so they're going to leave us guessing if we don't really see much happen today. So we'll see what happens next week. But I just wanted to maintain, we're coming up on that target there. So since the breakdown, that's about 7, and we'll be at about 8% gains, about 7.5 so far there. And let's look at gold. That's the more of the king of risk on assets, gold and treasury bonds, or treasuries number 1. So gold broke down, and again, that was a pretty significant breakdown. We've had this multi-week or almost multi-month trading range now, back from early April, and there it was. We hit it the other day, had one little bounce, back tested this trend line. We had this little trend line right here, and then that was it. So there's a breakdown in gold. puts it on a sell signal, and it could be a whipsaw. So we'll watch that. If the market were to do some crazy turnaround today or early next week, then what you want to be on lookout for is a reversal in gold. And again, these are GC gold futures clinging to divergences right now. It's not confirmed, not even close. I consider divergences confirmed when you get a on positive divergence, when you get a bullish crossover, when the PPO turns back up, because that effectively puts in a higher low. And so right now we have what I call potential divergence, and if so, that would be pretty powerful if we can recover that 1700-ish level. And I don't know if there's a trend line might be able to add. We'll look at this, just something to monitor. But as of now, like I said, the outlook is bearish. And will increase if we get a breakout in the dollar. So here's the dollar. Again, we had the minor trend line break recently that brought us up to the more significant, what I call, at least on this 60-minute chart, the primary downtrend line. This is the one the dollar futures need to take out. This is DX, same 60-minute chart I've been posting. And so you have a pretty clean price channel is really what we're looking at here. And we've been diverging all the way, and that's why I talk about divergence not being a buy signal. We had divergence there, and that was a cattle. We got a little pop, but that only took us to the primary trend line, and so that's it. So this still looks like we're going to get that breakout. And so therefore I think that's going to put additional pressure on gold. But remember, if something happens in the stock market, everything today across the board bullish action, but that can change on a dime. And if that does happen, especially if it's a sharp drop, then that may put a bit of a flight to safety bid back into gold and treasuries. In fact, treasuries, I'm going to get to those in a second here, look like they're going to bounce soon here. But again, we had a breakdown the other day that was pretty impulsive. Let's look at the euro real quick, and we'll move on to treasury bonds. Euro, that would be E7, euro futures. Same, we're still above trend. Same trend lines have been highlighting right here. This is our primary trend line right here. It needs to break to trigger a sell signal. We continue to diverge. There's your little divert. PPO has this small divergent high, and the RSI has continued to diverge from this point here. So still in an uptrend, no sell signals. And if we get one, then watch for a move down here, bounce off this line, and head down here to at least that minimum 111.06 target. And again, that should be a net bearish event for gold and silver if it happens. And net meaning, well, will that be countered out by anything that happens in the stock market? And this is ZB. These are long-term bond futures, treasury bonds. And as I pointed out recently, they were trading ever since the big drop, the bear market correction, whatever you want to call that, into the March lows. Everything went haywire. Liquidations, forced selling, panic selling. Nobody knew what was going to happen. And from there, that's when the Treasury stepped in, and everything kind of normalized, and nobody knew which way things were going to go. And it set us up in this multi-month sideways trading range, which we just broke out and back tested the other day. So that was a sell signal on treasury bonds, and they've just continued to fall. And so this is confirming right now the rally in the stock market. And you're seeing a impulsive move out of treasury bonds, which are your risk off assets. This is where institutions and some individuals flock when they're worried about the stock market or don't have a good outlook, and they start to so money is obviously flowing out of treasuries into stocks right now, which again, as it was the other day, that's supporting this recent move in the equity markets right there. And now one thing I want to point out here is go back to a long-term chart. That was a 60-minute chart we were just looking at. When I look at a daily chart, I don't know why this thing's not loading. There it is. When I look at a daily chart, there is a trend line that comes into play. We had it was nice and clean right here, but when we went through it, what that does is when we traded through it, it takes away the significance somewhat, but there's still enough reactions. This is what makes me keep that trend line there. There's a reaction. There's one from below. There's a couple more from below. One from above. We broke it, so we back tested, and then we regained it. And again, everything, I can only use the word wonky, or just got turned upside down, in the meltdown in March. So I think it was a valid trend line, and because of of everything that went on with the financial system just pretty much breaking at the time. I pointed out a lot of things broke. The Fed came in and fixed those things, such as the corporate bond market, the junk bond market. But there was initially a surge into treasuries and then a sell-off and then everything normalized. So again, I think the trend line is still valid, is what I'm getting at here. And the treasuries, they do trade well to technicals. You had a nice little wedge pattern there, bullish divergence that led to that big move up, and it was highlighted back then. And so here we are at trend line support is what I wanted to say. And we're also pretty darn oversold. If you look at, let's add a line right here on the RSI. You can see the last time we were this oversold was back here, and that was before a major move in treasuries. Do I want to go long treasuries here? No. And I told you before, even on the breakdown, I'm a little skeptical, only because the unprecedented, or involvement, let's just say, direct intervention by the Fed, which has destroyed the mechanism of price discovery. And so I'm just using this watch, pointing this out. Why am I covering it? Well, it's telling us right now that if you want to take it on face value, that's bullish for the stock market, this recent breakdown in treasuries and the impulsive selling. So until and unless that reverses, but I can tell you, whereas treasuries were an objective short on that breakdown, the other day. Again, I didn't take it, but where it was an objective short then, it's not at this point in time. We're a little too oversold. We'll probably get at least a snapback rally soon, especially if the stock market, takes a pullback later today or early or sometime next week. And then I know a lot of you don't trade futures, so we'll look at TLT. The same levels. That was a big level right here. That was where we were trading since the the meltdown in March into the March lows, and then we broke down. And TLT hasn't looked back. But what it is doing is coming up on support. I've had this line here for a while, defined by several reactions right there. So again, the case can be made for a bounce trade here, or at least some consolidation in treasuries. So to be very clear, I don't think the risk reward anymore is objective for shorting. It was there, but it's no longer now at this point in time. So probably get a bounce back. And then that also kind of plays into what might happen with the market. If treasuries do bounce off this support level, there's not necessarily, but that may coincide with a pullback in the stock market. So that's one worth watching. And the other one worth watching, I think, right now is junk bonds. This is JNK. You can look at HYG as another ETF that tracks holds junk bonds. But what I see here, this is a line that has a lot of reactions going back for a while. This line right here, you had reactions back in the last bear market there, spike off there, reactions there. We finally broke that. We had a breakdown below that support line, then recovered it and back tested successfully. Back tested. Remember, support once broken becomes resistance. So where we have traded through it, these were mostly in little crises, if you will, or corrections and or bear markets again in some sectors. The S&P 500 technically didn't have a bear market till here, came very close back here and here, and that's when we dipped below it. So the point is, that level, very significant. Every other time we're solidly in a bull market, we're back to that level right now. And not only were all those reactions that I just showed you help to validate that level, there's another one. There's a big old gap right there as well. So on a scale 1 to 10, probably a 7 maybe for resistance, which is pretty significant. And so I doubt we're going to see junk bonds continue to rally up on here. Today kind of has almost a FOMO type feel to it, fear of missing out. And you're having junk bonds at resistance. They tend to trade, I should have said that earlier. Junk bonds trade more in line with equities because they're unlike other bonds. Treasuries are rate sensitive, although there is that risk on risk off thing. But when you look back over time, sometimes treasury bonds are rallying and falling with the stock market due to other factors. Junk bonds, unlike all other investment grade bonds, tend to trade much more in line with the stock market, with economic expectations, because when everything's going good, see, they're not as rate sensitive because they pay such a high yield over all other bonds. And so what really determines their prices is the expectation and or the reality of the economic conditions at the time. Why is that? Well, these are all bonds. These are all companies that are on the verge of defaulting on the bonds. That's why they call them junk bonds. Anything that's below investment grade. When the economy is strong or improving, great default rates stay low. However, if the economy takes a turn, and especially you head into recession, default rates can soar on junk bonds. And so that's what happened there. That's why they had that plunge down there. They fell 24% or so there, which is a big move for bonds. Remember, bonds typically don't go up and down as much as the stock market. So that's it. Just want to point out we're at a very significant resistance level. This is a weekly chart right here. You can see it as well on the daily chart right there. There's that big old gap. Could they keep going? Yeah, it's possible. Can a case be made to short it? The same kind of case that I like to do. I'm either short a breakdown of support or a rally into resistance. All the better if you can see at least on the daily or 60-minute chart some divergence to help support it. So that's it. And if we were to pull back, there's just like the stock market, a gap to backfill there. That would be a logical target, and even a minimum target right there, just coming back to the trend line there. Junk bonds are bonds, so they're not going to move up and down as much as a stock market. So you can, if you're going to go long or short, you can use a little overweight your position. And I'm talking about swing trading, not investing, swing trading. Okay, and trade ideas. When I got back to my desk this morning, I had an alert that had fired off on BGG. Actually, it's moved quite a bit since then. That was this morning. It popped here and it's up another 5%, but it's still, it's helping to confirm the breakout. Now there is some resistance here. It's a low price stock. Need to warn about that. Briggs and Stratton Corp is a company. They make small engines, generators, things like that, and it has resistance right around the $2 level. You can see here. It's more of a minor resistance level. I put a higher weighting on these two trend lines. You can see right here. Now, I would say this. I would hold off on this one, and I am personally, until next week. Like I said, I'm a little suspicious of today's move. I want to see if the markets can hold up into the close today, and especially on Monday. Can they follow through to today's gains? The S&P 500, as strong as this rally is right now, is approaching significant resistance. It's still 6% or so, or whatever it was off the highs, and like I said, and divergences that remain intact on the a lot of the intraday time frames. But if we do continue up, and this one can hold the breakout, what you want to see is a solid close above here. So we're above there right now. It's up almost 12%. The profit potential, again, one of the better looking charts right now on this one, is about from where we're at. If I can grab it somewhere roughly there, easily, I'd see it easily if the stock market can hold up and continue to build on today's gains, and this breakout sticks. And that doesn't always have to happen. The stock market could pull back, and this one could continue to rally. So you're talking about 42% upside to that 280-ish target. And next target up there is about 388, about a 93% return. And if things continue to do well, maybe all the way up here at about $5. So I'm sharing this as more of a bottoming play and a swing trade. A swing trader would get in, take the breakout, maybe hit one of these early targets and get out. Whereas a trend trader, if you think we're going to continue, the economy is going to grow and the stock market's going to rally throughout 2020 and into 2021, then you look at a long-term trade, and BGG certainly has the potential to get back to $5 a share. It's a company that's been around forever. I don't know. They obviously have fundamental issues. If it got down in the below that $2 share price, never dropped below $1. So there's obviously things going on there with the company. But again, the case can be made. Strong chart here to me, or at least bullish potential there. It needs that breakout to stick. But so far, we do have the breakout. So again, if you want to take it on face value, that's what it is. Weekly chart. PPO is turning up from extreme low levels down here. You can see we are pending bullish crossover. Any more upside. So if this breakout sticks, Again, a lot of profit potential on this one. It's low price, so you don't put too much into it. You have nice RSI divergence here, positive divergence on the RSI, so that's one I wanted to share. LTM was one I shared in the recent videos. There were quite a few. A couple of them already hit targets. We had some nice moves there. LTM is close to backfilling that gap now, coming up on that downtrend line. We're probably 80% of the way as of earlier today on the gap backfill. And then let me just show you a few commodities that are moving today. Well, let me go to, what I want to start with is crude oil. I should have hit on that before, but since I'm on the commodities now, that's CL. All right, need to zoom out a little bit further and show you the weekly chart, or no, the hourly chart, sorry. Okay, this is the longer term trend line right here off the lows. On an hourly chart, which was broken recently, and we're back testing. It's hard to make out on here. I'll zoom in a little bit, and you can see that. And remember, crude tends to be a dollar-sensitive asset because it's priced in U.S. dollars. Means if the dollar rallies, that would put pressure on CL. These are crude futures. There's another trend line to watch there on a 60-minute chart. Let me go back to that 30-minute chart I started with and show you what I'm looking at here. Okay, that's the same, that shorter term trend line. This is the one to watch here. This is a 30-minute chart. So you have an uptrend line, continue to diverge. And again, to me, it's all about the dollar. There's also, crude will also rally, usually with the stock market. Because again, everything today, the news was on unemployment was positive, bullish. And so then if people interpret, well, there's going to be a higher demand for crude if the economy is stronger. So again, you're going to probably see, with the next pullback in the market, but most importantly, I want to see also that breakout in the dollar, and then still a lot of meat on the bone when we get a sell signal here, because you're talking first target down here about 34.76 from where we're at now. There'll be about 11, almost 12% drop, and quite possibly all the way down here to that $31 level. So watching this, still waiting for a break of the trend line. So no sell signal yet, and no breakout in the dollar yet either. And I think that is it. If you trade USO and you look at the daily chart, you have this very clean up trend line off the lows as well. Big old gap right here that USO has to contend with. It's entered the gap now. Let me draw that out for you. And the top of the gap would be your next logical resistance level. So let's put that right there. We're not far from it. And there's a trend line. PPO is still buried down into bearish territory, meaning it's crossed below the zero line. It remains below right now. So like everything else, crude oil is clearly in a bear market. I mean, there's no arguing that. Not everything else, I'm sorry. Tech stocks and others are no longer in a bear market, but most sectors are still below those highs, and that's what it looks like here in USO. So as of now, crude oil is not going to go to zero. Yes, it went negative recently. I'm talking, that's just more of a kind of a quirky thing with the futures. So I'm not expecting crude oil to go down to $5 a barrel or anything, but did want to point out that it's still in a bear market and coming up to resistance there. And select ag commodities continue to exhibit very bullish behavior. Just walking nice clean up trends. This is sugar up another 1.5% today. Also highlighted cane recently, breaking out of this inverse head and shoulders pattern. Nothing but green candles so far, up 6% in the last just this week alone. We have other, commodity index, commodity fund there. Soybeans continue to move up. They were highlighted breaking out here recently, coming up on the first target right now. Remember, unofficial trade on this one. I just haven't gotten around to adding targets and all these, but I had this level here, 419. So we're getting very close to that. Probably get a reaction there. But again, these look more like bottoming plays. I like to see the constructive. These are constructive charts, and so far, it's bullish price action following through. Corn starting to move on up as well. That's it. DBA, nothing exciting, because remember, the benefit of going with a very diversified ETF like this is diversification. The downside to going with a ETF like this is diversification. What do I mean by that? Well, the reason I do these videos is spend so much time going through the technicals of each and every in the ag commodity arena, is there are at any one point in time, some will be bullish, some will be bearish. One example is, I've been bullish on the grains recently, which are wheat and corn and soybeans. Well, what are the one of the largest inputs or costs for a farmer that raises livestock, pigs and cattle? Well, it's those. It's you got to feed them. You need the grains. So typically, you'll see when the grains are rallying, especially when they've been rallying for a while and prices are higher, it's putting pressure on cattle producers and hogs and things like that. Point being is that by going with this, you have the diversification that if one or two or three of these aren't doing well, hopefully the others are bringing it up. But on the flip side, they're also going to hold it back, and that's why you're not seeing the movement in DBA as you are in the rest, because we don't have yet a very strong broad-based rally. There's still some of the commodities that are not really taken off yet, like coffee, is one I'm watching. I still think it's an objective long. I still very much like the chart. I still may add it as an official trade. I just have to catch up with all that I've had going on lately, outside of trading and everything else. But again, it's at support right now, and we're going to end the video here. Just looking over my list, make sure I covered everything. Yeah, that's it. All right, let me get this out to you guys, and I'll do today. I will be around at the close, so we'll definitely do a follow-up video or end of week market wrap, and then we'll pick it up next week, see how things happen, what happens with the market, I should say. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.